Now, is it worth anything? Yes, right? This part of the conversation is called the Great Liquidity Reservoir, and I am going to struggle to convey just how much capital there is behind this regulatory dam, because the numbers are just monumental, right? How much money is there? Well, let's start with the most liquid of the liquid, right? Bank deposits, stocks, and bonds. $400 trillion. Right? Certainly more than my current retirement nest egg, and plenty of money to buy you a nice place in central London or San Francisco. Right? 400 trillion. There's another 379 trillion in real estate. Right? Gold is 13 trillion by itself. And then you get to the entire crypto ecosystem is like 2.5 trillion. Right? I'm not going to say all of this money is going into crypto, but quite a lot of it will end up in crypto, and a huge amount of it is going to end up in tokenized digital assets, right? Not because it's going to grow, it's going to grow by absorbing, particularly on the tokenization side, it's going to grow by absorbing a lot of these other assets that are less liquid or are not currently as easily tradable. Now, today, almost all of that money is sort of locked behind the regulatory dam. And a really good example is pension funds, right? A lot of the world investors today in crypto and digital assets, they're wealthy individuals who used to be wealthy environment. And even very modest allocations, even very small stuff, could end up being very large. Just think about gold. Right, this is maybe the best crypto comparison. There's $13.8 trillion of gold out there in the ecosystem, right? There's another, real estate, art, syndicated loans. There are lots of assets today that are not particularly liquid, that are ideal candidates for tokenization, smart contract automation, that kind of thing. Right? And we've been playing around with this for a long time, but a lot of times the banks that we work with don't pull the trigger because they don't feel comfortable with the regulatory environment. That is starting to change. How quickly will it change is a different question. And again, if you know me, you know I love looking at historical precedents. And a good one for this is the shift that took place over years when public pension funds and private pension funds started to put money in stocks and bonds. Right? If you go back to the 1950s, right, and fortunately we can't, but if you get data from the 1950s, you can go back and you can see that, in fact, at that time, even stocks were kind of considered risky, right? If you were a proper pension fund, you had your money in bonds, probably just government bonds. Over a period of about 40 years, the entire universe changed, and so that the majority of pension fund assets today are actually in stocks, not bonds, right? And so I am not here to argue that 40 years from now, the majority of pension fund assets will be in crypto. I think that is extremely unlikely. But I am here to argue that whatever amount is in crypto and digital assets, it's going to take 40 years. There are some pension fund managers out there who are already buying Bitcoin ETFs. They're excited about it. They want to buy digital assets. There are others who are like, no way. Right? There's a pension fund in the Netherlands that's performed really well for the last few years. They have something like 15% of their assets in gold. Right, but that's probably atypical these days compared to, say, the way things were 40 or 50 years ago. So it's a long cycle, but big shifts do happen over time. And in general, it's pretty typical that these shifts take 20, 30, 40 years, even if the technology and the product is available.
GDP, which is today at 84 trillion, is projected to double over the next 20 years, all thanks to technological innovation. We need to recognize the speed of change, the acceleration of advancement as an unprecedented pace because of the exponentiality of computer technology. With that as a background, I want to shift to specifically the exponential tech of blockchain technology and crypto. The Bank of England says this is going to transform the global financial system. 76% of TradFi is developing blockchain technology right now. Global spending in 2021 was $6 billion. Last year it was $19 billion. Gartner says that the global blockchain market, which is right now $176 billion, by the end of the decade will be $3 trillion. PwC says it's going to add nearly $2 trillion to GDP by the end of the decade. The technology lets businesses operate faster, cheaper, safer, with greater transparency and inclusion. JP Morgan says it's going to save banks $120 billion a year in processing costs. We have to recognize that all of this is all about the evolution of the internet. The original internet that was developed in the 1990s, we now refer to it as Internet 1.0, was all about connecting people. Right? You used email and texting, later Facebook and Twitter, where we used the internet to connect with each other. Then we had Internet 2.0, the Internet of Things, where your phone is talking to your car. We now are embarking today on Internet 3.0, the Internet of Money. We are now moving money at the speed of the internet, which is an unprecedented phenomenon. And since the world runs around based on money, this is going to be massive. We're already using the internet as a payment platform for the movement of money, everything from credit and debit cards to all of the different services that most of these you are already using. The best illustration of this are cross-border transmittals. This is a nearly $200 trillion marketplace of moving money from one country to another, either person to person or business to business. And of that $195 trillion, about 3% of it, look at the bottom of the chart, is used by crypto. So of all the money that's being moved, most of it is going through the Fed, and most of it's going through SWIFT. It's going through bank wires, Western Union, but 3% of it is being done with Bitcoin or stablecoin or some other digital asset. It's projected that by the end of the decade, it is going to grow to $300 trillion, and crypto's share will be 20%. A 7x increase. 12% of global trade is cross-border transmittals. Think about migrant workers. They come here from South America, Central America, Africa, the Far East, for economic opportunity. Mama is still home in the old country. So what does the worker do? They send some of their paycheck back home to mom. Migrant workers send $1.2 trillion to over 800 million people every year. 60% of the average family's income comes from those cross-border transmittals. This is 3 times more than families receive from international aid. This is a huge number. Look at the amount of money that countries are receiving from cross-border transmittals. Over $100 billion goes into India. $60 billion flows into Mexico. Even China gets $50 billion. Some of these very small countries get a huge percentage of their annual GDP from money being sent into it from expats who have moved to other countries and are sending money back home. Crypto share is going to rise 7x by the end of the decade. Why? Because of unstable local currencies. If you live in Zimbabwe or Venezuela and you can't trust the value of the currency because of massive inflation where prices are doubling monthly, or a government that is corrupt and nationalizes banks, literally steals the money out of your bank account, you don't want to put money in a bank. The cost of transmittal, if you want to send money from New York to London, it typically takes 5 days and costs 6%. The cost is exorbitant. And people are becoming increasingly aware that there's an alternative. They can use crypto, which is faster, safer, and cheaper than doing it the old way. Just look at sending a wire cross-border. 5 days, 6% using the SWIFT system, which only operates during banking hours. With Solana, you can send that money in less than 1 second for a tiny fraction of a penny, and you can do this 24/7, no bank required. You don't even need a smartphone. An ordinary cell phone will do. There's 1 billion people in the world who are unbanked according to the United Nations. They don't live anywhere near a bank, or they don't have enough money to afford being able to open a bank account because of either the minimum deposit required or the fees the banks charge. We're even talking about 7% of US households who are underbanked or unbanked. Payments technology of crypto allows this to occur faster, easier, safer, can't be manipulated by governments, extremely divisible, because the dollar only goes to 2 decimal points. With Bitcoin, it goes down to 9 decimal points. This is why there's 500 million people around the world who are in crypto. We've got to change our thinking. Everybody keeps looking at Bitcoin saying, what do we need this for? Why do I need digital assets? Our banking system works fine. We all love to hate banks, but let's face it, it works just fine. Yeah, that's true here in the US, but it isn't true in the rest of the world. That's why the rest of the world is really interested in this technology. And for all of that, people are only a small, tiny piece of those remittances. It's governments and corporations that are sending most of the money. If you have heard of Kinesics, you know who Kinesics is operated by? JP Morgan. This is JP Morgan's private blockchain. They've got their own private blockchain. They've had it for 4 years. They do $2 billion in cross-border transmittals for their institutional clients per day. They've transmitted over $1.5 trillion so far on their own private blockchain. We've got over $5 billion tokenized of treasuries through public blockchains. That's a 10x increase in just 1 year. BlackRock and Franklin Templeton. Money market fund that is an app. It's not an account through your brokerage account. Higher yield, lower fees, instant 24/7 transactions. We already have 65 million Americans who own this. 28% of US adults own Bitcoin. PayPal lets everybody on its platform buy and sell goods using crypto. Walmart's got Bitcoin ATMs in all of its stores. Fidelity and Schwab both accept Bitcoin as charitable donations to their donor-advised funds. Last year, they collected over $400 million in Bitcoin donations. You think your clients, wealthy clients, aren't investing in Bitcoin? Well, who's donating the $400 million to these guys? You can now make political contributions to your favorite candidate in Bitcoin. You can pay your taxes in an increasing number of states in Bitcoin. You can pay for college tuition in an increasing number of colleges in Bitcoin. People say to me, well, what are the use cases? There aren't any. Really? Here's a sample of the B2B. Here's the B2C, the C2B, and the C2C. There's a huge number of technologies and use cases for this asset class.
That huge equity allocation, crypto needs a much bigger role because it's representing the best investment opportunity of the decade.
Now, I want to point out that your current viewpoint represents a dramatic shift from before when you used to tell investors and recommend that investors allocate low single digits to crypto in portfolios. So what has changed now? Why do you think specifically now you can allocate up to 40% in portfolios. I mean, that's a big jump.
It sure is. In my
Yeah.
book, The Truth About Crypto, which was a #1 Amazon bestseller, that was in 2021, just 4 years ago, and I said 1%. Today, I'm saying 40%. That's astonishing, right?
Yeah.
Nobody ever anywhere has.
As I explained to your audience today, I see crypto as much more than just a new asset class, but really a new architecture of finance, a new way of establishing who owns what and who's transferring what to whom, using the internet as the basis for establishment of that value, as opposed to the individual balance sheets of proprietary institutions. It's a new architecture, a new protocol for establishing value. In any commodity market, the price of the underlying commodity is actually not set in the physical or the spot market. The price is set in the derivative markets. Mature derivative markets are essential for price discovery because it's the one place that all the buyers and sellers can come together to agree on price. That's why the price of gold is not set in a jewelry shop. It's set in the derivatives market. The price of wheat is not set at a grain elevator. It's set in the derivative markets. The price of oil is not set at the gas pump. It's set in the derivative markets. So establishing well-functioning, healthy derivatives for crypto will provide a solid basis for price discovery and price setting for crypto.
So let me get to the derivatives, because that's where the things get juicy, okay? And I think this is Ripple's ultimate goal for what they're building. They have a product called Codius that's been in beta for a long time, but it's a smart contract derivatives platform. And so all of these structured derivatives products, right now you can't even quantify derivatives. People don't even know their risk. That's why Lehman and all those people failed in 2008, is they had all these mortgage-backed securities that they had packaged up and sold and taken leverage on and done a bunch of stuff with, which is gambling, but they do it because they make a bunch of money. They can't even quantify their risk. And nobody can tell you how much the derivatives market's worth. It's somewhere between 400 trillion and like $4 quadrillion. And if you had an accounting mechanism that could be used to identify all the risk across that and issue all these derivatives, because they're complex, you need some smart contracts that are really complex to be able to do this. And that was on the XRPL, and XRP settles those. Now we're talking like $10,000 to $50,000 an XRP. And that's, I think, 5 years.
If you were an internet investor in like 2004, you might have decided, I want to bet on the best company in the best space. And in 2004, that was Google and search. And that turned out to be a great investment. Google's up about 7,000% since then. So kudos to you. But the internet was more than search. It was also retail, which was Amazon. It was B2B, which was Salesforce. It was video, which was Netflix. And actually, Netflix is up 100,000% since then. And I raise that as an analogy for crypto to tie back to what we talked about earlier. Bitcoin, I think, is a phenomenal investment at what it does, right? It is the best project in the best space today. It's like Google in 2004. And I suspect over the next 20 years, it's going to be a fantastic investment. But crypto can do more than just that decentralized non-government store of value. There's also the equivalent of Amazon, the equivalent of Salesforce, the equivalent of Netflix. And that's why, we're diversified holders, and we like Ethereum, and we like XRP, and we like Solana, because there are these other use cases. And I think that's a useful analogy to remember. It's not that the Google investors were wrong. They were right. They 7,000%ed. It's just there was also Amazon, and there was also Netflix. There were these other things you could do with the internet, and there are other things you can do with blockchain. And I think that's the analogy that really appeals to me.
5 years, yeah.
So,
it's for a dumb reason.
Swift today, there's two ways to think about Swift. There's the messaging, and there's liquidity. Right. Liquidity is owned by the banks. Right. I think less about the messaging and more about liquidity. Because if you're driving all the liquidity, that's good for XRP. Right. Anyway, so I'll say 5 years, 14%.
I'm Rhonda Swan, and welcome to today's Wall Street Minute. Today we're walking down Wall Street with Jake Claver, digital currency expert and director of Digital Ascension Group. Jake, there's a lot of optimism right now around Bitcoin. However, you have a different opinion.
I do, and that involves a reverse carry trade. So in Japan, people have borrowed trillions of dollars over the last couple of decades, and that's going to have a huge impact on the market when the Bank of Japan raises interest rates in the very near future. You're going to see tons of treasuries flood onto the market from foreign debt holders, and they're going to have to pass stablecoin regulation here in the U.S., which will then cause problems for Tether and Bitcoin. And that's the opportunity here. If you're positioned in the right digital assets that are actually going to be the ones that settle the back end of the stock market and save the day on this, that's where people need to be, and that's where our clients are positioned.
Thank you for watching Wall Street Minute.
So let's talk about XRP because I bought a chunk. What happens if it goes to 2,500? What needs to happen for that to happen?
There's a lot of things that that's the requirements for that to happen. A lot of people just tell you, oh, there's, flip a switch, get out of here with that stuff. There's actually global macroeconomic events that need to play out in order for that supply shock to take place to push it to that value. And that's what it would have to be. There's supply and demand economics. People look at total market cap, but in reality, it's whatever the supply is on the market for purchase that drives the liquidity and the market dynamics and value.
But can't they make more XRP?
They cannot. So originally there was 100 billion, XNS was what it was originally called, minted June 2nd of 2012. And they black holed that account. So what that means is nobody has access to it. They can't get back into it. They can never mint more. Nobody can freeze the XRP. It is locked at 100 billion and 5,000 of them are burnt every single day. So it's literally the only deflationary asset besides like uranium on the planet.
But that makes it more valuable.
Yeah.